Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video and if you are new here, definitely hit like and subscribe so that you can watch future videos as well. But today we're going to talk about a pretty commonly discussed topic actually with stock market investors, and that is how to go about investing your first $1,000. So there's a few different opinions on how you should be going about that. You know, should you be buying individual companies? Should you be buying an ETF? Should you be trading options or doing all sorts of other complicated things that you can probably also do with $1,000 in the market? I'm going to give you my opinion, so definitely drop any comments down below or any questions you have down below. And just remember, I'm a guy on YouTube that makes, videos about money and stuff. I'm not a financial advisor, so take this with a grain of salt. This is just my opinion and for entertainment purposes only. So let's get into it. So when you're investing your first $1,000 into the stock market, I think there's a couple of things that we need to consider and kind of take a step back and look at what you're actually trying to achieve here. So the end goal with investing in general is to lay out money today and have it be worth more money in the future. And if you're doing that over a long period of time, you're hopefully going to be continuing to lay out a lot of money from your job or from your business or whatever it is, and continuing to grow that nest egg over time so that one day you're financially independent and you can retire and live a stress-free life money-wise at least. So in saying that, there's a couple of things that we really want to achieve with this first $1,000. The first thing is we want to get it invested somehow. There's a couple of laws of compound interest and the maths behind compounding, and one of those laws is that the longer that you have money invested and making a return, the bigger your nest egg is going to be in the future. So it's important to be investing for a long time, and in other words, it's important to get started early. So if you're in your teens or your 20s, you're in the prime kind of time to get started investing. If you're a little bit older than that, certainly don't stop. Investing now at 30 or 40 is going to be much better than starting investing at 50 or 60 or a couple years from retirement. So the earlier you can start, the better. The second thing we want to achieve with this first $1,000 is we really don't want to lose it all. The last thing that we want when you're investing your first $1,000 is to discourage you from investing more in the future. The whole purpose of investing your first little bit of money is getting it into the market, seeing some positive results, and really getting your mind kind of in that stock market investing mindset. Wanting to build and build and build over time so that you can have something substantial at the end. And if you go and invest $1,000 in something that goes to zero, that's going to deter you massively from investing more money in the future. So that's the second thing we want to achieve, is we want to ensure safety of your principal. We don't want to have you losing 80 or 90 or 100% of that money on your first investment, because it's going to deter you from investing in the stock market in general. So those are kind of a couple of the things we want to achieve. Let's get into a couple of different methods and a couple of different sort of approaches you can take on doing this. And then that way, I hope you'll be a bit better informed on what your sort of options are with getting money into the market. So let's get into it. So option number one for getting your first $1,000 into the stock market, and what I recommend to basically everybody that ever asks me this question, is to put your money into a market tracking ETF or an index tracking ETF. So basically what that means is there are things called exchange traded funds or ETFs, and the goal of these funds is to mirror the performance of some sort of stock market index. So if you've ever seen a financial network news, or if you've ever gone onto some sort of financial app, often you'll see a few of the common indexes or indices. So things like the S&P 500 index, you may have seen the All Ordinaries or the ASX 200 in Australia. You may have seen the Dow Jones also in the US. You may have seen the NASDAQ also in the US, or you may have seen something like the NZ Top 50 here in New Zealand. So all of those are indexes, and they track a series of companies. So the S&P 500 in the States, for example, tracks the largest 500 companies by market cap in the US. The Dow Jones has, from memory, 30 companies. The NASDAQ is basically a lot of the newer technology companies publicly listed, and the NZ Top 50 is the biggest 50 companies by market cap in New Zealand. So the largest 50 businesses that are publicly traded in this country. And one of the great things about investing in an ETF is you get instant diversification. So I know I've done videos on the channel bagging on diversification, but for your first investment, I really want to ensure safety of principal, and I don't want you losing 100% of your money. It's not a guarantee that ETFs won't go down 50 or 60% at some point, but I really want to ensure that you have safety in your first investment. So when you go out and buy an ETF, it's a really convenient way to get a lot of diversification. So in practice, if you want to buy, say, the New Zealand Top 50 Index, there's a stock traded on the New Zealand Stock Exchange called FNZ.NZ, and that is the New Zealand Top 50 Exchange Traded Fund, or ETF. Basically, you can go ahead and buy that one stock, so you can put your $1,000 into that one stock if this is what you choose to do. And by buying that one stock, you're investing in a fund that is diversified across those big 50 companies in New Zealand. So it saves on fees. You only have to place basically one trade, as opposed to placing 50 trades if you were to buy all these companies individually. And you get a lot of diversification. You're not going to have a company that goes to zero. You're going to have 50 companies. For that ETF to go to zero, all 50 companies basically would have to go bankrupt, which is extremely, extremely, extremely unlikely. So you're not going to have as many worries there. The unfortunate downside of that is you're probably not going to have your money double in the next year or 2 or 3 years. But it at least gets you into the market and, gets you into that stock market building kind of mindset. So that's option number one. Let's get into option number two. Option number two, and something that you might choose to do if you're a little bit more game, is to invest in 1 or 2 individual companies. So depending on the country you live in and the exchange that you're trading on, there will be some sort of minimum investment requirement. So I believe that's $500 in both New Zealand and Australia. You guys may be able to tell me what that is in the US. So what that means is you're going to be able to invest in an absolute maximum of about 2 companies if you choose to. So a couple of things we want to do with choosing individual companies. There's a couple of benefits, there's a couple of drawbacks. Basically, the benefits are there's a lot more upside potential. So just like I mentioned with the ETF earlier on, you're diversified across 50 companies, and the chances that those 50 companies on average are going to double in a short period of time is not likely. It's much more likely if you do invest in an individual company that has some good growth prospects, that you're going to have that stock price appreciate much faster. The unfortunate downside of that is you also have more downside. So if the company does not meet its growth targets, or you invest in the company when it's trading at quite a high valuation, and again those growth targets aren't met that are priced into that high valuation, then you're going to have a lot of downside and potential for loss. So couple of things I want you to really focus on here if you do choose to go down this route. I think you need to basically understand the 4 M's of value investing. So do you understand the company? Do you understand the products it sells, how it makes money, what factors may influence the ability of that company to make money in the future? Does it have a moat? So does it have some sort of competitive advantage over other similar companies in its industry? Apple, for example, has a brand moat. Facebook has a network effect sort of moat, so it gets a lot better. The product itself gets a lot better because more people are using it, and it makes it very difficult for competition to come in. There's things like being a low-cost producer. So if you're a commodity producer like a milk company or a mining company, often being the low-cost producer is a big competitive advantage. You can stay profitable a lot longer than your competitors if prices go down for those commodities. So those are some examples of moats. The other thing is you want to have a great management team. So a management team that's trustworthy and that performs very well and provides high returns for investors. And you also want a margin of safety. So you want to be able to buy that company for much less than it's worth. And that means you're going to have to know how to value a business. So I do have some videos on how to do basic valuations on companies on the channel. So if that's something of interest, definitely check it out. So that's basically what you're looking at of buying individual companies. So there's a little bit more work and potentially a little bit more risk if you don't know what you're doing with that option. But that's basically option number 2. And getting this first $1,000 into the market is very, very important for you. And I just want to spend a minute or so on a couple more reasons why, and a couple of things to watch out for when you're making your first investment. So in terms of things to watch out for, there's a couple of things that can really bite you, I suppose, with small amounts of money especially. The biggest one is probably fees. So if you're investing $1,000, for example, if you have quite a high brokerage cost to actually make that trade, let's say it's $30, that is going to be a reasonably large percentage of that investment. And if you also have to pay $30 to get out of that investment, if you want to sell it in the future, that's $60 out of your $1,000. So that's about 6% off the top before you've done anything. So you're going to have to make at least a 6% return to break even on that investment. Hopefully you're holding these investments for the long term, but that is one to watch out for. So potentially you might want to investigate using some sort of discount brokerage. So I know ASB, for example, offers $15 brokerage now. Still a fairly hefty percentage of your $1,000, but it's cheaper than it certainly was in the past. You've now got platforms like Sharesies, which I know have actually just come out with sort of individual company brokerage. It's something I may have to do a video on in the future. A couple of you guys have messaged me about that, so there's that one. And if you want to invest in something like the States, then you've got Hatch Invest for New Zealanders. These are the brokerages I'm talking about for New Zealanders. It'll be different in your own country, so do some research there. But you've got Hatch Invest if you want to invest in some of the countries in the States as well. So those some options there. Look out for fees. The other thing I just quickly wanted to mention on your very first investment is to focus on the long term. So one of the interesting things that happens when you first get invested is what a lot of people do is they download the stocks app or the Yahoo Finance app and add their portfolio to their phones, and they will be instantly addicted to their phones checking the prices of all these stocks. So what I want you to do is really focus on the long term with this one. Buy these companies as if or these ETFs as if you're going to hold them for the rest of your life. And if you're going to hold something for the rest of your life, what's it matter to you if the price changes, in 15 minutes time? You're not going to sell it in 15 minutes time. If you happen to look at your phone and see the price has gone down 0.5%, it doesn't matter to you. You care about what the price is in 10 or 20 or 30 or 40 years from today. You don't care what the price is tomorrow or next week or anything like that. So if the price does change dramatically, don't get caught up in that. Forget about it. You've made the investment. You may have made a mistake if you've bought an individual company, but if you're investing for the long term and you've bought a great company or you've bought an ETF in a great country that will grow over time, you'll be fine. Don't stress about those little up and down movements. It's actually one of the great advantages of something like KiwiSaver here in New Zealand, or 401k retirement plans in the States, or equivalent retirement plans in several other countries. A lot of regular Joes that just go to work and have a retirement plan and aren't particularly interested in the stock market or investing, one of the fantastic things they do is they don't care. So they're not logging into their retirement accounts every day or every week or every month even to check what their balance is doing. And what it means is that they don't make rash decisions, which as a long-term investor is hugely powerful. So focus on the long term. Don't get addicted to your phone and to your computer and checking the prices of the couple of stocks that you own at the beginning. That's a couple words of advice. I think that will do nothing but stress you out and make, potentially cause you to make rash decisions. So those are a few of my top tips there, and that's my opinion on how you should go about investing your first $1,000. So I hope you enjoyed the video. If you did, as I say, hit like and subscribe. We're trying to get to 1,000 subscribers here over the next 6 months or so. So if you could help me out with that one, that would be fantastic, and I hope you have a great day. Cheers.